welcome on board Pranjal Bhandari, Chief India Economist and Macro Strategist at HSBC, joining in on the show right now. Pranjal, hi, morning. Great to have you in the show. Just going through your latest note, Pranjal, and you've raised your FY27 GDP focus now to 6.3%. With the MPC decision due this week, how much of that growth upgrade is already in RBI's own numbers? And could the policy statement this week itself validate or challenge your call?
Well, look, I think growth has been remarkably resilient. Into the energy crisis, one would have thought that production will come down for manufacturers, but actually it just went up. A lot of interesting things happened, which we can now say with confidence in retrospect. One was that last year there was a lot of policy stimulus in the economy. There had been a lot of monetary policy easing. GST rates had been cut. There had been regulatory easing. So all of this had also been helping growth this year. And then once we got into the energy crisis, many manufacturers, they thought that, look, whatever energy stockpile we have right now, let's use it to produce. And we saw output going up, stock of finished goods going up, even urban employment was inching up. So my sense is that all of that kept, growth strong. And finally, there was also the tariff issue. Last year we were getting this 50% tariff from the US, which currently is running at about 10%. It could grow up in the future, but as long as it's a low 10%, many exporters are also front loading their exports to the US. So this has all come together nicely. Domestic activity, export activity, all looking very strong. And my sense is, you spoke about my numbers for the fiscal year FY27 at 6.3%, but for the calendar year 2026, my sense is GDP growth will average about 7%, which I think is quite remarkable at a time when we've had so many uncertainties around us. As for RBI, my sense is they have already been quite positive on their growth numbers, so they may not have to make any major adjustment there. If at all they will make any adjustment, I think it will be on the inflation front.
Interesting. And what do you sense is going to be the inflation adjustment from RBI?
Well, look, firstly, RBI does not like to change forecasts every meeting. They like to create some consistency. So firstly, I'm not even sure if they'll make any change. But in case they make any change, I think it'll be a minor change. They had inflation averaging just over 5. They may bring it just lower than 5. Our own number is about 4.8% for the year. RBI is about 5.1% for the year. So not a very big difference. But if you look at this number very carefully and not look at the last 6 months of the fiscal year, but the next 6 months of the fiscal year, you'll see that we have inflation, both RBI and us, averaging more than 5% for 6 months at least starting October. And I think that is when it's going to start dawning on the RBI that there are a lot of inflationary pressures out there which need to be handled. And at that point, we may see some rate hike, but I think that will happen in the October meeting. That may not happen in the August meeting because so far, all the inflation numbers we've had so far on CPI have been all right. They've not been very high. The last number was 4.4% when RBI's target is 4. So a little high, but not too much. So they may not do anything in August, but come October, they may think about inflation numbers that will now look more than 5% and they may hike then.
If that's the case, do you think the RBI will prepare the street for an eventual increase in interest rates? Because last time the governor told us that if it was looking at an interest rate hike, it would have done that and not taken the steps they have taken.
That's a very good question. Well, look, my sense is that they will call out some of these upside risks to inflation, which have been there on the back of, energy prices being higher, now food prices selectively inching up, and also the currency depreciation that we've seen since the start of 2025. All of these numbers are already visible in the WPI inflation, PPI inflation, which are running at about 9.5%. So they could alert the market about this and say that it hasn't trickled into CPI inflation, but some of that could happen, in the forthcoming months and prepare markets from that perspective. So yes, I do think there will be a bit of that in this policy meeting, but at the same time, they don't want to rock the boat yet. I don't think they will overtly sound hawkish or change their stance from neutral to hawkish. I don't think that will happen. In fact, I think through this entire cycle, even if they hike later or they don't, they will maintain the neutral policy stance because it's a very, very helpful stance. When you're neutral, you can do anything. You can stay on hold, you can cut, you can hike. The best thing you can have available to yourself in a world which is constantly changing.
Pranjul, the other thing which is coming out surprisingly is the resilience of the economy in terms of manufacturing, in terms of the GST collections that we are seeing. So consumption has not been hit despite the fact that there's a cost escalation, and as you said, it hasn't trickled down to CPI. But do you think that if the WPI trickles down to CPI now, going forward in the next few months, we might have an hit on more margins and more consumption?
Well, that's an interesting one. When we look at what is happening with corporates and we follow both their input prices and output prices, input prices have been rising more rapidly than output prices. So far, corporates have been taking the hit on their margins and they have not been giving it to the consumers. But we also see that once this happens and it stays on board for 3 to 6 months, then corporates start, increasing consumer prices as well. So my sense is that, in the last quarter of this calendar year, we will start seeing CPI inflation rise as well. WPI, PPI are rising. I think it's a matter of time before when manufacturers also start passing on prices. Not a lot, but I think a little bit because they have to preserve their margins as well. So from that perspective, I also have in CPI inflation averaging more than 5% for 6 to 8 months starting October. And those are numbers which I think the RBI will not be able to ignore. And that's why I call for a shallow rate hiking cycle starting October.
Pranjal, I also want to talk about, the estimated potential inflows from the Forex package. We've seen that number being floated as well. How much of that has actually materialized so far, according to you? And is that pace tracking your base case?
Well, it's actually done very well. When you compare to 2013, most of the money flew in at the fag end of the entire package window. But this time we have had quite a lot of inflows even at the start. So I think it's off to a good start. One reason could be that markets had already seen this package back in 2013. So it wasn't a new package, and many banks were able to quickly come out with their offers on the back of it. My sense is that I think it's going to be a strong one. We've been working with $65 billion inflow, coming out of the announcements of the RBI on 5th of June. And so far, I'm going to hold on to that. I know some people have higher numbers, some people have lower numbers, but I'm happy with $65 billion because just with $65 billion inflow from this package, we are able to have a BOP surplus of about $40 billion in this fiscal year, which is rather elevated. Last 10 years, the average was $25 billion. So we're already at a mark which is higher than last 10 years. And I think this will give a lot of dollars to the RBI in the short run to intervene in the market if there is exchange market pressure or the rupee comes under pressure or suddenly the dollar surges or suddenly oil surges. There are so many moving parts, but the RBI right now is sitting on a good amount of FX reserves with which it can try to stabilize the currency and even strengthen it. And you're already seeing today the price action on the currency. The rupee looks much stronger today.
Pranjul, do you think that the kind of flows which are coming in from the FCNR window is more than enough to offset the deferral of Indian bonds into the Bloomberg All Aggregate Index? Because there we were expecting between $15 to $25 billion coming in if it gets included to that index. Now that's getting deferred and there's no timeline for it. The estimate was that towards the second half, you will have the additional flows coming from there. So, do you think this is more than enough to offset that kind of flows which were expected?
Yeah, look, that's a good question. In terms of the numbers, it is. We were expecting about $17 billion coming had we gotten included in the Bloomberg's Barclays index. That has not come, but on the other hand, we have even higher number, $65 billion, what we are expecting from the entire FX package that the RBI has announced. So number-wise, we are fine. But what we need now is that we need to have another flow of money from somewhere else, because remember, this FCNR window will close in September. And very soon markets will start asking from where will the next round of dollars come? Earlier, the thinking was that, okay, FCR window will close, but then, we will have the bond inflows to look forward to. But if that is not happening, the pressure to generate dollars from some other source just rises a little bit. So from that perspective, yes, I think the pressure will be to show new sources of inflows into the economy. But look, I'm not going to be all depressive there. I think a couple of good things are happening. The one thing that I'm most excited about is all of these trade deals that we are signing. I think once we from our EU, India, UK, India, these trade deals get fully functional. I think India could become a place from where manufacturing exports happen, and we could see signs of it in FDI inflows as well. So I do think that some other avenues of inflows are still alive and kicking. It's just that we have to keep persevering on them.
How do you look at the cross-currency headwind which is coming in, especially the joint intervention between the US and the Japan on the yen? We've seen roughly around $60 billion being pumped in to support the yen. Do you think further rise in yen could have a different impact on currencies and for the Indian currency as well?
Well, look, I must say that whatever's happening globally, obviously currencies are always seen as pairs. So the impact will also be there in dollar INR. But to the extent that right now we have the FCNR program running and we are going to get inflows irrespective of what happens to US treasuries or what happens to JPY, because we have this very special package running, we are a little immune from whatever is happening, relatively a little more immune than other countries from what is happening globally at this point of time. So we have bought ourselves a few months in which we remain a bit protected because we are getting these inflows, we are getting all of these dollars that the RBI can spend. But eventually, we have to find new, more permanent sources of inflows because the FCNR money has to be repaid back, right, in a 3 to 5 year horizon. But I think for now, we are relatively immune, not fully, but relatively immune to what is going on in many of the other, FX pairs.
Angel, great having you on the show today.